Hi guys, today I'm going to be talking about the Forex market and sort of the basics of it and how to get involved in starting to trade foreign currencies. So the first thing I would like to suggest is that you open up a practice account. Now it doesn't matter where you open this up. I suggest Investopedia.com because you can sign up and they have a embedded Forex platform so you don't have to download anything, and it's 100% free and it's pretty accurate to what the other expensive programs and platforms would offer. So it's a really good, tool to get you used to what Forex is, and you can play around, not lose any real money, and sort of get the feel of things. So once you get on here, you obviously see all the currency pairs on the left side, and you see a graph of whatever currency you pick. So in Forex, you have what's called a bid and an ask price. So this is the price that you can buy the euro against the dollar, and this is the price that you can sell your euro against the dollar. And so depending on what you are speculating that the market is going to do, depends on which trade you want to make. So let's open up a better chart here that's from dailyforex.com. You can get this for free as well. So let's look at euro to the US dollar. That's the most commonly traded pair. So here's a pretty simple trend that's going on. It's clearly going up and down, up and down, up and down. So when it's going up, the euro is appreciating against the dollar, and then when it's coming down, the euro is depreciating against the dollar. So here it looks like it just made a pretty strong trend up, and then it should be breaking at this point and coming down. So if we wanted to try to profit off that, we would be betting that the euro is going to depreciate, so we would want to sell the euro. So you would come over here and click sell. I've already done that for you just to show you guys. And here is the trade down here. So obviously from that point that when I've done that to now, it's only gone down about 1.6 pips. So I haven't really made too much of a profit yet, but hopefully if the trend continues, you could make a profit on that. So let's go up here again and talk a little more about the currency pairs over here and what this all means. So the difference between the price you can buy at and the price you can sell at obviously is around 3 points, or what they call pips. A pips is just one movement in the currency pair. So this difference here is how the platform makes their money. Instead of charging commission, they just charge what's called the spread, or the spread is this difference here, and that's really how they make their money on every trade. So let's say if I bought right now for 19 and I sold the same second for 16, I would be down 3 pips. So that 3 pips right there is the automatic commission basically that the platform is taking. So in order to make profit, you have to first cover the spread, and then anything after that would be profit. And it depends on what currency pairs you're looking at. The more highly traded currency pairs are often the ones with the lowest spread, so that's basically the lowest commission. Obviously, if you're trading like Chilean pesos and Afghani, whatever their currency is, the spread's going to be a little more, and it's going to cost a little more for you to make that trade. So let's go ahead down here and look at our trade, what we just made. So we're betting again that the euro is going to depreciate against the dollar, and then when it gets down to a point where we like it, let's say at this horizontal line I put in would be a good spot at 1.3543. So when it gets down to there, we'd be hoping to buy back that currency, and then the difference in the exchange rates is where we made our profit. So let's say we didn't have time to sit around here and we wanted to make sure that trade got met if it ever went down there. You can go ahead and put in what's called a take profit or a limit order. You can also do that for downside protection as well. So let's say I was wrong about the speculation and that instead it made a strong uptrend from there and started a new trend. I could put in, let's say, I'll put in a line right. Oh, sorry, wrong one. I could add in what's called a stop loss, where basically it would stop you before you lost too much money. So we'll go ahead and put in both of those just in case and see what happens. So first let's put in our take profit or our limit order. So 1.3543, that's where we're hoping it would go. So the currency go in here, down here, and we're going to add a condition. So we're going to do take profit and a stop loss. So what we wanted at our take profit was 1.3543. So let's go ahead, 1.3543. And the stop loss was up at 1.3632. 1.3632. Okay, so you can see right here that our stop loss went in and our take profit also went in. So just in case any of those things happen, we will be protected by our profit will be protected if we ever hit this margin, and our losses will also be minimized if it ever decides to trend up. So that's pretty much the basics of Forex, the very, very basics. I know I left out a lot of things, but I just wanted to show you guys what a basic trade looks like, what people basically look for when they're trying to make a trade. It's all about charts, really. You want to look at a trend and try to mimic that trend. But I'll be the first person to tell you, and I'm sure it won't be the last, that nothing in the past really ever guarantees the future. So you never really know what's going to happen. You can be almost certain that the trend is showing that it'll depreciate and it'll shoot up 100 pips or so, and like that you'll be out a couple $100 or whatever. But that's why it's important to keep a practice account before you really go into real money trading. I also would advise you to keep your leverage low if you ever really do start trading real money in the Forex. What that means for you people that don't have a business background is leverage is basically the amount of money you can borrow based on the money you have. So here it looks like my leverage is 20 to 1. So for every dollar I put in, or obviously this is fake, but if it was real, for every $1 I put in, I could borrow up to $20 to trade with that. And that's sort of where people get into trouble with Forex, is that some platforms allow 100 to 1, allow 100 to 1 leverage on your trades. So if you only have $1,000, you can trade up to $100,000 in currencies, which, if you're borrowing more money, your gains are going to be obviously exaggerated, but so are your losses. So any small, decline in the market could cause you to lose that $1,000 like that. And that's where the rumors really come from. So as long as you, keep your leverage low and only make small trades and practice on your practice account before you really start doing this, you should be fine. You won't lose, a dramatic amount of money unless, like I said, you're being stupid with the amount of money you're trading. So let's see how this trade is working out here. Oh, it hit something. So obviously let's see if you go to close trades. So it either hit our stop loss or it hit our take profit. So it looks like it hit our stop loss. So it started to trend up. Let's look at our bigger graph here. Yep, see, it's trended up a little bit. I bought it about here, and obviously this one barely hit right here. It hit our stop loss. So it bought back our currency before we could lose any more amount of money. So it looks like we lost about 11 pips on that trade, or 12 cents, because we were only trading $100 or 100 units of this currency. But pretty much that's it. If you guys have any questions, I'd like you to put it in the comments. I will be making more videos about more advanced topics in Forex, but I just wanted to show you, like I said, a basic Forex trade and what people do and how they protect their gains and their losses. So let me know if you guys have any questions.